Hey everyone, and welcome back to the channel. Today, we're re-diving into a topic that has been causing some serious waves in the financial world, the silver market. It sounds simple, right? Silver is silver. But what if I told you that right now, the price of silver in one part of the world is dramatically different from the price in another? This isn't just a small fluctuation. It's a sign that something fundamental is changing, and the global silver market as we know it might be breaking apart. Let's get straight to the numbers because they tell a fascinating story. Recently, physical silver in Shanghai has been trading at a price equivalent to around $105 per ounce. Now compare that to the price on the COMEX exchange in the West, the hub for paper silver contracts, where it's been trading closer to $93 per ounce. That's a gap of about $12 for the exact same ounce of metal. Now, you might be thinking, okay, a little difference. What's the big deal? But in the world of global commodities, a gap this wide is a massive red flag. It's not just a premium, it's a chasm. In a healthy, functioning market, this kind of price difference shouldn't exist for more than a few moments. It's a textbook arbitrage opportunity. Traders would instantly buy up the cheaper silver in the West and sell it for a huge profit in the East. This buying and selling action would naturally balance things out, pulling the prices back together until they were nearly identical. It's the basic law of one price, a cornerstone of efficient markets. The fact that this $12 gap isn't just a momentary blip, but is actually persisting, tells us something is seriously wrong. The arbitrage isn't happening, which means the silver isn't moving. So what does this mean? It means the silver market is no longer a single, unified global system. Instead, we're witnessing the emergence of two parallel systems. On one side, you have the Western paper market, dominated by financial contracts and derivatives on exchanges like COMEX. This is where price is often driven by speculation, algorithms, and financial engineering. On the other side, you have the Eastern physical market, led by places like Shanghai, where the demand for actual tangible metal is the driving force. Here, it's not about contracts. It's about getting your hands on real bars and coins. Supply and demand for the physical product, not financial speculation, is what dictates the price. This isn't just an interesting economic quirk. It has huge implications. When a market splits like this, history has shown us a consistent pattern. Eventually, the price of the physical asset, the real thing you can hold in your hand, wins out. The paper market can play its games for a while, but ultimately, it has to reconcile with the reality of physical supply and demand. The physical market will eventually set the true price, and the paper market will be forced to follow or risk becoming irrelevant. Let's think about the scale of this price gap for a moment. A $12 difference per ounce is enormous. If you were an institution able to move, say, 1 million ounces of silver from the West to the East, that would represent a potential profit of $12 million. That is an incredibly powerful incentive. In a normal world, an opportunity like that would trigger a tidal wave of metal moving from cheaper regions to more expensive ones. The sheer force of that capital-seeking profit would slam the price gap shut almost immediately. But it's not happening. The silver isn't flowing. This is the crucial point. It proves that there are powerful structural barriers preventing the market from balancing itself. The system is clogged. So what are these barriers? First, there's the issue of available inventory. We keep hearing about how much silver is supposedly in vaults like those of the COMEX and LBMA. But how much of that is actually available for sale and immediate delivery at the current paper price? A lot of it is already spoken for, held in ETFs, or owned by long-term investors who have no intention of selling. The pool of for-sale silver might be much smaller than the headline numbers suggest. Then you have logistical nightmares. We're still dealing with global supply chain disruptions. Moving large quantities of precious metals across the world isn't as simple as booking a flight. It involves specialized security, transportation, insurance, and navigating customs. These processes are slow and expensive, and any delays can eat into potential profits and add risk. And finally, we can't ignore the possibility of government restrictions. As countries become more focused on securing their own resources, they might become less willing to let vast amounts of a critical monetary and industrial metal leave their borders. We could be seeing export limitations, either official or unofficial, that are preventing the silver from going where the demand is highest. So when you add it all up, limited available stock, logistical hurdles, and potential government actions, you get a fragmented market. The free flow of metal that's supposed to keep prices in check has been severed. As a result, price discovery is breaking down on a global level and is instead becoming a regional affair. The West is pricing its paper contracts, and the East is pricing its physical bars. They are arriving at very different conclusions about what silver is worth. What we are watching is a real-time tug-of-war between paper and physical. It's a battle between financial promises and tangible reality. This growing disconnect is a clear signal that the underlying supply of physical silver is much tighter than the paper markets would have you believe. The demand in the East is real and relentless, driven by industrial needs and a cultural affinity for saving in physical precious metals. They want the metal, not a piece of paper that promises the metal, and they are willing to pay a significant premium to get it. This isn't just about silver. This is a story about the changing global economic landscape. It reflects a shift in economic power from west to east and a growing distrust in financialized paper-based systems. People and nations are increasingly seeking the security of hard assets. For anyone interested in precious metals or even just the stability of our financial system, this is a critical development to watch. The widening gap between the Shanghai and COMEX silver prices is more than just a number on a screen. It's a symptom of a much deeper issue. It's a crack in the foundation of the global market structure, and it suggests that the real price of silver may soon be determined not by traders in New York, but by the physical demand from the other side of the world. Thanks for tuning in today. This is a complex but incredibly important topic, and we'll be keeping a close eye on how it develops. If you found this analysis helpful, please give this video a like and don't forget to subscribe and hit that notification bell so you won't miss our future updates. I'd love to hear your thoughts on this in the comments below. See you next time. Have you ever looked at the spot price of silver and wondered why the coin in your hand costs so much more? It's a question that perplexes many, but the answer might lie thousands of miles away in the bustling markets of Shanghai. Today, we're diving deep into a fascinating story unfolding in the global silver market, a story of physical metal on the move, tightening supplies, and a growing disconnect between paper promises and real, tangible silver. This isn't just about numbers on a screen. It's about a global tug of war for one of the world's most critical commodities. So what's happening? In simple terms, Shanghai is paying a premium for physical silver, and that premium is acting like a powerful magnet, pulling metal right out of Western vaults in places like London and New York. Think of it like this. If one store is offering you $10 for an item you own, and another store across town is offering $15, where are you going to sell it? It's a no-brainer. That's essentially what's happening on a massive international scale. The higher prices on the Shanghai Gold Exchange are attracting silver from all over the world. As this metal leaves Western vaults, something crucial happens. The amount of silver available for immediate delivery shrinks. This is where things get really interesting. When the pile of available silver gets smaller, the risk that someone might not get their metal when they ask for it, what we call delivery risk, goes up. And what happens when risk increases? Buyers get nervous. They become more willing to pay a premium to secure their metal right now, rather than waiting and hoping it will still be there later. This creates a powerful feedback loop. Higher prices in Shanghai pull silver from the West. This drain tightens the Western supply. The tighter supply makes buyers nervous, so they pay higher premiums to get their hands on physical metal. These higher premiums signal to sellers that there's even more money to be made by shipping their silver to where the demand is strongest, which, you guessed it, is often Shanghai. And so the cycle continues, accelerating the price gap between the physical metal and the paper contracts that are supposed to represent it. Now, you might be thinking, what about the big financial players? Why don't they just buy cheap silver in London, ship it to Shanghai, sell it for a higher price, and pocket the difference? This is called arbitrage, and in a perfectly efficient market, it would quickly close this price gap. But the silver market is far from perfect. Arbitrage is failing, and there are three main reasons why. First, you can't just go out and buy a massive amount of physical silver at the spot price. The act of trying to buy, say, 1 million ounces would signal huge demand and immediately push the price up. You'd be chasing the price higher with your own purchase, and you would likely exhaust the available supply from sellers willing to part with their metal at the lower price. The paper price might say one thing, but the reality of acquiring large physical quantities is completely different. Second, logistics are a huge hurdle. Moving tons of silver from a vault in London to a vault in Shanghai isn't like sending an email. It's a complex, expensive process that takes weeks, sometimes even months. During that time, the price difference that made the trade profitable in the first place could evaporate. A trader could lock in a purchase in London, and by the time the metal arrives in China, the premium might have shrunk or disappeared entirely, turning a surefire profit into a loss. The time lag introduces a level of risk that many arbitrageurs are simply unwilling to take. And third, there's a wall of red tape. You can't just decide to ship $1 billion worth of silver into China. There are significant regulatory controls, import licenses, and capital restrictions. Only a select group of authorized entities have the ability to navigate this complex system. This means that even when the economic incentive is incredibly strong, most market participants are locked out. They can see the opportunity, but they are powerless to act on it. These frictions are what allow the paper price, primarily set in Western financial markets, to stay low, while the physical price, driven by real-world demand, keeps climbing. But who is driving this relentless physical demand? It's not just investors. A massive component is industrial users, and unlike a financial trader, they cannot wait. Think about the world's biggest growth industries right now: solar energy, electronics, and electric vehicles. What do they all have in common? They all need silver. Solar manufacturers need silver paste for their panels. Electronics producers use it in everything from your smartphone to your laptop. Electric vehicle companies need it for various components and connections. For these industrial giants, silver isn't an investment. It's a critical, non-negotiable raw material. A production line shutdown costs millions of dollars a day. Compared to that, paying a few extra dollars per ounce for silver is a small price to pay to keep the factories running. They will pay whatever premium is necessary to secure a continuous, reliable supply. This industrial demand forms a solid base that is much less sensitive to price fluctuations than investment demand. They have to buy, regardless of the price. The data from the vaults confirms this story loud and clear. Let's look at the COMEX, the primary futures and options market in the US. The amount of silver in their registered category, which is the metal actually available for delivery to contract holders, has plummeted. Since 2020, we've seen a drop of more than 100 million ounces. That's a staggering amount of silver that has left the system. And it's not just a US phenomenon. The vaults in London, managed by the London Bullion Market Association, are showing similar dramatic declines. The metal is physically leaving the exchange-controlled systems. It's being bought, taken delivery of, and shipped to where it's needed most. And here's the kicker: it's not being replaced. Why? Because new supply from mining is already stretched thin. Most of what comes out of the ground each year is already spoken for, committed to long-term contracts with those same industrial users we just talked about. There's very little new, unallocated silver hitting the market to refill the vaults. The world consumes virtually everything the miners can produce each year. So what does this all mean for the future of silver? It means we're living in a world with two silver prices: the paper price, which is influenced by financial derivatives and trading algorithms, and the physical price, which is dictated by the old-fashioned law of supply and demand. As long as industrial demand remains robust and the logistical and regulatory hurdles prevent arbitrage from closing the gap, this disconnect is likely to continue and possibly even widen. The flow of silver from west to east is more than just a footnote in a financial report. It's a symptom of a major shift in the global economy. It reflects the rising industrial power of Asia and the fundamental reality that in times of uncertainty and high demand, physical possession of an asset trumps a paper promise. The Great Silver Migration is a story every investor should be watching closely. It tells us that what you can hold in your hand is becoming increasingly valuable in a world full of paper claims. Thank you so much for joining me today to explore this fascinating dynamic in the silver market. If you found this breakdown helpful and want to learn more about the forces shaping our financial world, make sure to hit that like button and subscribe to the channel. Don't forget to ring the bell so you never miss an update. We'd love to hear your thoughts in the comments below. What do you think this trend means for the price of silver? Let's discuss. Thanks for watching, and we'll see you in the next video. All right, let's talk about silver, because right now we are sitting on a powder keg and the fuse is lit. The stage is set for a massive repricing event, one that could fundamentally shake the global structure of silver markets. Now, imagine this scenario. A large, aggressive industrial buyer in China suddenly steps in and bids aggressively for millions of ounces of physical silver. What happens next? Shanghai prices would spike instantly. That immediate spike would trigger a cascade. Traders, sensing arbitrage opportunity, would be forced to buy COMEX futures here in the West and immediately demand physical delivery. But here's the critical, terrifying reality. COMEX simply does not have enough readily available eligible metal to satisfy a large-scale coordinated delivery demand. This is the heart of the paper versus physical conundrum. When that demand hits, the exchange, COMEX, is faced with a terrible choice. They would be forced to drain their vaults down to dangerous, critical levels, or they would have to radically change the rules of the game, raising margins so high they lock out smaller players, or perhaps the most damaging, forcing a cash settlement instead of providing the promised metal. Either outcome is catastrophic for market confidence. If they drain the vaults, it shows their reserves are paper thin. If they change the rules, it instantly undermines any remaining confidence in COMEX as a true price discovery market. It proves that the system is rigged and that the screen price does not reflect reality. There are really only a few ways this escalating situation can possibly resolve. First, and perhaps the most logical, Western paper prices must rise dramatically to meet the physical reality. The current disconnect, the gaping chasm between the paper price and the actual cost of acquiring and delivering physical metal, must close. Second, the markets could completely decouple. COMEX could essentially become a paper-only reference point, useful only for speculators, while all meaningful, actual physical trading shifts elsewhere, perhaps to Asia or private exchanges, ignoring the Western benchmark entirely. Third, governments could intervene. This is a risk, especially if the industrial base starts screaming for metal. Governments could intervene with strategic stockpiles if they exist, or impose capital or export controls to stabilize the supply chain, but this is a temporary fix that destroys trust. Fourth, and the least likely in the near term, a major new supply source or a widespread effective industrial substitution for silver could emerge. Given silver's critical role in solar and electronics, this seems almost impossible to pull off quickly. The most probable and necessary outcome is the first one. Western prices must rise to close this dangerous gap. That significant difference we see daily between the Shanghai future exchange prices and the COMEX prices is not a small anomaly. It is not just minor volatility. It is a deafening warning signal. It tells us that physical silver is scarcer than the paper market admits, that inventories are draining rapidly, and that the screen price, that number you see flashing, no longer reflects the real physical cost of acquiring the actual metal. Remember this fundamental distinction. Paper, in the form of futures contracts, can be created instantly, infinitely, with a click of a button. Physical silver cannot. It must be mined, refined, and stored. It takes time, energy, and resources. And when the two diverge, when paper promises outstrip physical availability, the vault, the actual physical inventory, not the trading screen, is what ultimately determines reality. The clock is ticking on this arbitrage opportunity, and the pressure is building for a massive repricing. Hit that like button and subscribe so you don't miss our deep dive into exactly which industrial sectors are most likely to trigger this squeeze. Thanks for watching.